Hi everyone, I'm Michael Frazis, a portfolio manager at Frazis Capital Partners. We invest in technology in the life sciences, specifically in companies with three characteristics: true customer love, exponential growth, and genuine market leadership. We focus on a small number of very fast-growing areas. Things like software, e-commerce and online retail, digital payments, digital health, and the life sciences. We believe Australians are actually significantly underinvested in these sectors, and particularly in the kind of global market leaders that we invest in. Our fund is an Aussie unit trust, and if you'd like to invest alongside us, please get in touch. I thought today I'd just give an update of our latest results, kind of how we're looking at solar, a couple of comments on technology in the technology space at the moment, and then maybe a bit of an outlook on financial markets and how we see things at the moment. The fund did 16.7% net in May, which took us up 10% for the calendar year to date and over 20% for the financial year to date. I think the advantage we had was obviously technology went on an absolute tear. And it's actually something you've seen in most crises in the past, particularly recent ones. So 2016, 2011, obviously 2008, 2009. In general, technology sold off with the market and then recovered first and then made new highs, shortly after each of those kind of corrections. I think there's actually something systematic going on there. I think that's actually something you can expect to see going forward. Because you think about what happens in these cyclical sell-offs, typically there'll be like kind of decline in global output. So revenues will be down around the world. There'll be a handful of companies, particularly in technology, they're able to grow revenues and grow users throughout that period. So when people kind of like look around at the bottom of what they need to buy, where they want to allocate to, there's only a handful of companies able to grow through those like cyclical lows. And it just so happens that those are, e-commerce, digital health, companies in areas that are growing very fast, that have enormous multi-year tailwinds. The share prices are very, very volatile, but the earnings growth and the revenue growth in particular is actually not so volatile. It's actually steady. It's almost metronomic for some of the best companies. So if you invest in technology companies in cyclical downturns, you have this huge tailwind of returns. There's other factors as well. Typically what happens in a downturn is that governments try and stimulate. So central bankers will cut rates. They'll pump liquidity into the market. In severe instances like 2009 in Australia and all around the world, this time governments will actually hand out cash to citizens and companies. And so that cash kind of needs to find a home. People get their stimulus checks and think, where are we going to invest it? And the natural home for that is the handful of companies that are able to grow throughout. And then add in the fact that interest rates are lower and these are kind of fast growing firms where so much of their values in the future, you can see why you get these like huge uplifts in valuations, right? When most of the market is, severely depressed. So you think about the market in general, if you knock 3 to 5% or even more if you're talking about the last few months, if you knock that off the revenues of the world, of global GDP, that's really going to hit cyclicals very, very hard. So that's why you've got this huge disparity between this phenomenal outperformance of certain parts of the market that are able to grow, and then severe falls in other parts of the market that have collapsed. And it's completely rational. It's exactly what you'd expect. The interesting thing is those fast growing tech companies are often the companies that perform best, throughout the cycle. So it's not just a kind of, early recovery story. It's actually throughout. And again, it just comes back to that value creation. They're constantly growing. Would you prefer to be in a company that's twice the size as it is today that it was last year? Or do you want a company that's roughly the same, but maybe you bought a 20, 30% discount? So in many ways, I guess the performance that we've got over the last month was full credit to the technology sector and like the underlying trends there. We also made a decision, which we discussed last webinar, to orientate the portfolio entirely into sectors that were accelerating and visibly accelerating. And that really paid off dividends. So, e-commerce players, their revenue growth were going from 60% to 80%, in some cases more. Digital health obviously exploded. These are trends these were long-term trends with very good reasons behind it. Like, it's intrinsically better to buy things online in most cases. You have, broader selection, it arrives to your door. It's just much better. This shift has really accelerated that. And that's probably another characteristic of why technology outperforms so much in difficult times, is because there's something about these crises that encourages changes of behavior, and many of those changes of behavior become effectively permanent, especially when there's like a good reason for it. And this was this crisis was a particularly pronounced example of that, because all of our behaviors changed dramatically. We weren't allowed to go out. We were in many places in the world, people were locked in their houses. Everybody had to buy things online. If you wanted to see a doctor, you definitely wanted to do it digitally if at all possible. So it really was that behavioral change is certainly evident in other crashes, but it was by far more pronounced in this case. The interesting thing about that is that these trends have continued. So we try not to have strong opinions about these things. We don't try and pick what product people are going to like, what payment option people are going to select on a website. We're really trying to avoid making those decisions. What we want to do is we want to see the data. We want to see what people actually are clicking. We want to see what people are buying, and then really let that guide our decision making. So when we look at the performance of e-commerce over this period, it's those trends have continued. You can track these things on a day by day or even week by week, or certainly week by week basis using web traffic stats and things like that. And it looks like as the economy's opened up, the shift to online retail is here to stay. And it's exactly what you would expect if you consider that that it's just a better way of doing things. So we've been a bit of a beneficiary of that. But broadly, the performance was pretty broad. It was, I think the largest contributor, the 16.7, was 2.6 from Afterpay. So you can see that the performance was, across a large number of stocks. We're holding over 35 at the moment. So we're highly concentrated in those areas that are growing, where you really want to be. But we're quite diverse within those sectors. And that has also seemed to really help. You saw last week, there was kind of a sharp, short-lived value recovery, which then got smacked down on Thursday with, -5, -6, -7% moves across indices. And, the extra diversification we've added really showed there, because we weren't particularly hit particularly hard. In fact, it was quite a good week for us. So it really shows the benefit of these kinds of companies, because people are increasingly realizing that they're defensive. Another reason technology is defensive, I think there are a few now, is that they're typically like net cash. These aren't leveraged cyclicals where a small drop in revenue effectively wipes out their profits. These are companies sitting on big cash, bases of cash, and then like the equity value effectively comes on top of that. And one of their main costs is employee costs. They have that lever where they can pay stock-based comp, and effectively conserve their cash even more. And so you can see, like in these times, particularly after the first shock, you really want to be invested in technology, because that's when the fiscal stimulus comes in, monetary stimulus comes in, and these companies are growing so fast that, let's say they crashed in February, we're now in June, they're materially bigger than they were even back then. And that's really an advantage of growth investing. You've got this long tail, this huge tailwind of the fact that companies themselves are just growing and growing. Nothing we talked about in the note, if you read it, is solar and renewables. That's really in a double sweet spot. So the double sweet spot is basically people and governments around the world are trying to use solar a lot more, use renewables a lot more. I think everyone just wants it. It's nice, irrespective of your politics. I think we could all agree that it'd be a much more elegant world if it was all entirely sustainably, or energy was entirely sustainably produced. And then the second part of the advantage is that people are just clamoring for the shares. There's like huge demand, huge inflows into ESG, and ethically responsible funds is basically almost the whole market now. Everybody's trying to shift towards these kinds of strategies, and there's only a handful of market leaders. I'll give you a couple of examples of those. One's Enphase. So if you think about a row of panels on a roof, they'll be getting DC current from sunlight. Now we use AC, alternating current. So that needs to be converted by an inverter. Typically these will be kind of at the end of the panel, and if something goes wrong along that, then the whole system's basically broken. And often it'll require a technician to actually climb onto the roof. What companies like Enphase do is they invert the current panel by panel, and it's all software enabled. And it's very easy for a technician to kind of see exactly what's wrong, which panel needs to be replaced, or where there's an issue. There's basically two companies that lead the market there. It's Enphase and Solaredge. The other really interesting dynamic there is that a lot of people, the solar's boom and bust. So there's like huge waves of demand, then supply takes a while to catch up, and then there's like enormous amounts of oversupply. So there's constant boom and bust in the industry. Through that, the installers who often make the decision over what technology to use, really only want to use the leading two providers. And the reason for that is, often they'll be expected to fix the panels over the next 20, 30 years. which is quite a big ask. I mean, these panels are exposed to sunlight, wind, rain, hail. They're on the roof. You know, it's tough. It's really tough conditions. And so they'll want to use suppliers that they can rely on. They know they'll be able to call in 15 years' time and have someone pick up the phone and offer a spare part. And there's really only a couple of companies that have proved they can withstand those companies. I mean, there's very little reason for somebody to install it to go for the third or fourth best. Another concern around these shares, which kept them really cheap, was that there'd be oversupply of from China or some other low-cost manufacturer in the United States, which is obviously the biggest market. That is not something we are too concerned about. Like, I just don't think Huawei is going to come in and flood the US market anytime soon under either Republican or Democrat politician. There's some other interesting ones. So hydrogen is finally coming of age. So there's a company called Plug Power. What Plug does is they'll offer hydrogen batteries that will slot right into the existing battery slot of, say, a forklift. So you don't actually need to buy any forklift or do any kind of installation. You can just like slot the hydrogen battery pack here. There's quite a few advantages of that. I mean, because it's not like batteries obviously like get weaker and weaker with time. To the kind of second half, they're quite noticeably slower, noticeably less power. Hydrogen doesn't have that issue. It's also much faster to refuel them. Think of how long it takes to charge a battery. You can't charge it fast or you'll cause damage, potentially even start a fire. But something like hydrogen can be refilled automatically. And obviously the game plan for Plug is to kind of use their warehouse infrastructure to build up like a hydrogen infrastructure all across the United States, and then eventually make it possible for people to use, I guess the stage is probably delivery vans and things like that, then eventually cars. And there are some intrinsic advantages of hydrogen. For example, that immediately, that really fast refuel compared to, say, charging a car for a couple of hours. So it's a really interesting thing because it's one of those chicken and egg problems, which Tesla was very good at solving. If you want to make these huge changes, you really need to kind of stage it very carefully. And that is something that Plug is doing pretty well. Very well, in fact. Trying to think of some other companies. I mean, Tesla's continuing on to new highs. The Model 3 is the best-selling car in the UK now. So all those statistics about how it was ridiculous that Tesla was valued more than other car companies. Well, they are actually winning, like, on volume in most markets. They're also winning on margins. These are expensive cars. And I've written about this before, but I think the smartphone industry is a good example because everyone knows that we're going to slowly switch to smartphones. I'm talking about like many, many years ago. The question was, who would be the winner? Would it be Nokia? Would it be Samsung? Would it be Apple? Would it be any of the other competitors? What I'm happening is everybody competed on features apart from Apple. Apple was able to charge more for their phones, people willing to pay because they were seen as and were superior devices. And then the entire profit margin of the industry went to Apple. There was huge revenues going to the other people, but they were effectively fighting over the scraps. I think many years, actually, the entire industry lost money, apart from Apple, which made a lot of money. You can really see that happening with Tesla in cars, in the sense that Tesla has the brand. Tesla can charge a premium, and all the competitors will have to fight over features, over range. It'll be really difficult at the bottom. And so they're kind of in a sweet spot there. So that's kind of like one of the interesting sectors that we haven't talked too much about. But it's really that confluence. It's a confluence of rapidly increasing demand and then clamoring for the shares by investors, which I think is why the funds have performed, the stocks have performed so well. In terms of other things, I guess the other thing I wanted to talk about was probably the outlook. I mean, what's changed from when we last spoke? Equity prices have risen further. We're getting closer to, well, I guess the NASDAQ actually reached new highs. Many of our stocks are at new highs, if not the majority. So there's been a clear change in price. When I look around, I think sentiment is another indicator. So on some measures of sentiment, it looks like things are very red hot. Those measures would be things that involve price. So there's been a huge rally off a very low bottom. So anything that involves that kind of statistic suggests the market's hot. But if you look at, for example, sentiment as measured by surveys, or far more importantly, cash holdings, still seems very negative. Like, no one's really buying this rally. It really reminds me of I guess, actually the default state, kind of after 2011, 12, 13, 14. Got a message. Got a question. I'll come back and answer that. I've lost my train of thought. This was a question about Livongo. Are you still bullish at its current price? Okay, I guess Livongo is exactly what we're talking about in the sense this is a very, very good company that has rallied hard. I think in these cases, I mean, we have reduced the position largely because we've had inflows, but we're still long and we'll stay long. I mean, this is a long-term story. This digital health thing is not going away. These companies are going extremely fast. So yes, this is very much a hold for us. I wouldn't necessarily go out and rush and buy it. But it's not something we're going to sell here either. And broadly, I think that's actually how we're viewing the market. I mean, if you've got companies growing at 80%, a year, some more, some less, you actually want to sit and ride those things. The fact that stocks are up 20% in a month, I mean, actually expect them to be up 20% in a quarter. And they're big moves, but they're also coming off a very low base. I think that comes back to that whole, like, where are we in terms of sentiment? Where are we in terms of markets? If you take it from the lows, everything looks very hot. If you take it from any other period, it doesn't. If you look at kind of the last year, things are flat to down, depending on which index you look. And it's really, if you look at the peak in December 2017, say early January 18, many markets are down or sideways over that period. So coming up to like 2.5 year mark, basically sideways movement. I don't see any exuberance. I don't think there's any, apart from in very small sectors, it still seems like it's a very depressed market. Everybody's very cautious. Everybody's holding onto their cash. And, in my experience of the last decade, that's typically when markets tend to grind higher. The thing that would really trip it up would be if rates started rising in any significant way, or policymakers started talking about removing the stimulus. Like, that's probably when you'd want to get out. But typically, the incentives on policymakers are so skewed to err on the other side. There's no benefit to a central banker raising rates before they need to. And in fact, there's been recent examples where they've tried. For example, in 2011, Trichet and the ECB in Europe raised rates and basically triggered the whole euro crisis, a very serious round of the euro crisis. Looking back, it's bizarre that in the middle of that crisis, he was raising rates. But that was kind of like that generation. They kind of idolized those moves by central bankers in the 80s where they lifted rates to crazy, 14% plus. Crashed markets, crashed economies, tamed inflation, and then basically set ourselves up for, the last 30 years or so of positive price increases. So that is the concern. To me, it's less about, second waves and what people are actually saying, whether data is good or bad. I mean, the economic data has very much been surprising on the upside. It's employment data, retail sales, which again is exactly what you'd expect. I mean, it's a temporary shock and life has gone on. So I'm pretty still midterm, quite optimistic. Although, of course, you've got to be very careful in these markets. You don't want to buy something that's doubled. You can probably hold it, but it's not something you want to be rushing into at the highs. I'm trying to think if there's any other questions or anything else we should talk about. Broadly, in terms of where the virus is at, you are seeing increases, but you're also seeing. So there are genuine fears of the second wave in the US. I think it was actually the lockdown that caused the trouble for financial markets anyway, rather than necessarily those statistics. That was kind of like an early story. The biggest effect on markets will be if economies shut down again. Everybody's got an opinion on this. My opinion is they won't. I think it'll be broadly seen as they were quite drastic measures. And, in many cases, we're not that far away from vaccine. These vaccines, phase 3 is about to start in early July for Moderna's. There's a UK group that's very close. AstraZeneca is saying they'll have production ready by October of their vaccine. They haven't proved it works, but there's no reason for it not to work. Do you expect another down leg in the market in the short term? Or is there so much liquidity waiting on the sidelines it won't be as deep as the last dip? The way I'm looking at this is I think we have a range. I think if you think about where markets bottomed and what it takes to create those long-term market bottoms, there's a huge panic. They locked down London, New York, and around then there was a number of limit down days, but around then, with it give or take a few days, that's when markets bottomed. To get people to sell their stocks, their high-quality companies that are making money, and it takes a real shock. I think you need to see something worse than that. And it's not going to come from something that we have at the moment. Coronavirus won't scare people as much. If anything, now everyone's thinking, I wish I had a chance to buy all those stocks, where they were in March. I think that's what almost every professional I'm thinking I know is thinking. Everybody's wondering, why didn't I buy then? Why wasn't I a buyer? we were a buyer, but we're also pretty long on the way down, so we didn't get the full advantage. I think you don't really kind of claim it if you effectively move to cash first and then buy on the way down. But I don't think there's any. I think you could definitely see another leg down. Of course you could. There's no rules here, but I think it'll be bought very heavily, and I don't think it'll go anywhere near the recent lows. Like I really feel like that will be potentially even one of those lows that we never come back to, and that's been my view. How does the approach to valuation tech defer to valuation renewable names like Solaredge and Enphase? Well, I guess these are tech. Now we often use EV sales for tech. Often that's because they're software companies and their gross margins are 90% plus. So, the revenue basically is gross profit or very close to. Something that's actually like making widgets. So in this case, microinverters, that's got a margin. It's also got EBITDA. You can actually use EBITDA multiples for these things. And that's how you want to value them. Rather than sales. You've got to take into account the actual margins that they're making much more carefully because there is actually very high incremental cost of creating a product. Whereas in software, the incremental cost is zero. So the calculations are a bit different. But in many ways, you're still looking, where's this company going to be in 5 years? What's like the map of, what's the range of outcomes it could have? Firstly on, I guess in this case would be EBITDA, but secondly on a valuation of that EBITDA. And these companies are growing extraordinarily fast. And so if you can actually hold them for 2 to 3 years or 5, they'll be materially bigger and better places. And something like Solaredge is probably, even on a multiple basis, is probably undervalued at the moment. They just bought the second biggest battery maker. So they're really making Enphase, if you want to think about those two, Enphase is very targeted. It's a very small part of the market. It's a very specific part of the market. Solaredge is much more comprehensive solar solution, solar play. So it's an interesting one. I think I might wrap things up there. And we talked about the recent results. We talked about solar renewables and gave a bit of an outlook. Broadly, I think it's positive. I think dips will continue to be bought. And we'll probably be buyers of that dips. I mean, our positioning, we're holding a little bit of cash, more than 5, less than 10. And we'll continue to be buyers. And it's been a pretty good June so far. Are there any ASX stocks in the portfolio? We have Afterpay. Afterpay is the biggest position, but it's not a crazy size. Most of our positions are kind of in the 2 to 4% range, and Afterpay would be, 7, 8%. It's just a function of the fact this is up, and we bought it $4, and it's well over 50 now. So we have actually reduced that to limit the risk. I think Zip was an interesting transaction. So Zip bought QuadPay, and then the price popped. That's an entirely rational thing, I think. They went from being a domestic player to having at least some international play. I think it's definitely worth a lot more with the transaction than without. But, you've got like, say, a number 2 player in Australia partnering up with number 4, number 5 player in the US. It's not that exciting. I think we never own Zip. We don't own Zip. It's just something we're happy to watch from the sidelines. We still own Xero. So Xero is obviously a long-term hold we've had for a few years now. Actually, in 2016, 2017, our top picks were Afterpay, Appen and Xero. They all perform pretty well. So there is a lot of opportunity in Australia. But I think at the moment it's probably about 10% of the portfolio if you add it all up. We participated in a number of capital raisings as well. So we have some of those shares still, and they're at quite a good discount. Okay, I think I might wrap things up there. Thanks so much for signing on. If you got any questions, feel free to shoot me an email at michael@frasescapitalpartners.com. And we'll do the same thing again next month. Hope you have a great day.